Hello, greetings and salutations. Welcome back. I just wanted to do a quick video and a quick live. Yes, a new 1 hour video of Nick Link just came out updating us. So I just wanted to wait for a couple of people to trickle in and was going to watch this with you guys and just wanted to share it on the BFC channel, Buffalo Fireside Chats. If you're tuning in and haven't subscribed, please do so. Yeah, I was literally out just working in the yard, playing with the dog, and yeah, so so I wanted to check this out. So if I leave for like a second here or there, it's just because I'm taking care of house duties right now. So yes, if you're watching right now, like, share, and subscribe. I'm gonna wait for a couple other people to join me. Right now we have 6 people, and I'm gonna check. Let me know who you are in the comment section so I know who is with me right now. Um, I'm gonna pull this video up. I have not watched it yet, and a couple of people were like, "You should probably watch it first." I go, "Oh, you know what? What's wrong with a little bit of live shock?" No, I'm sure Ilus isn't going under, but I really am looking forward to this hour-long update from CEO Nick Link. As you guys know, this is my favorite OTC stock, so so I'm sure that we're gonna get a lot of good stuff. Especially if you guys had a chance to see the tweet that they posted with all that's happening in Serbia. I thought that was absolutely amazing. Let me pull that up for you right before I get into this video, because I do want to get into the video and keep it, to what we're doing right now. Let's go to the Ilus marketing page. And I thought this was really cool. Let's see. I got the tweet here. Boom. So check this out. E-Raptor production shifts to Serbia in September, and we have been at the facility inspecting the production line, components and materials, exploring new manufacturing contract opportunities in the EV and renewable sectors, and meeting with the Serbian Chamber of Commerce. So here is a video of it. Cute little mom and pop shop there. Here's some pictures. I don't know who those gentlemen are. So it looks like they have their hands full over there. It's pretty awesome, not gonna lie. And there's a couple other pictures too. Love the boat and the background music. But you could see, obviously things are taking shape. I wonder who that guy is right there. I don't know. Who's that big lug? I know who it is. It's JP. Hopefully we'll have a JP on the show sometime soon. We'll see how that goes. So yeah, I'm pretty excited. I'm pretty excited for where we're at. And for those of you that are just able to jump on and join me randomly in the middle of the day, thank you very much for joining me. So like I said, leave a comment. Let's get right to this video. I'm going to share the screen, and I'm just going to sort of just watch. I'm just going to watch with you guys. So enjoy. Ilus intro on 3. 1, 2, 3, go.
Hi, it's Nick, CEO of Ilus International. I thought I'd come to you today with a little bit of an update. I know you've been hearing a lot from JP. I've been really focused behind the scenes on driving the team, getting this whole process done. Uplisting is definitely not for the faint-hearted. The good news is, once we've learned, and got the process right and kind of worked out the team and the infrastructure and the people behind that are needed to get this done once, it should become a hell of a lot easier going forward. So anyway, I know there was, a lot of shareholders messaging saying they haven't heard from me for a while. So here I am, actually coming to you from the sofa that I did the very first Ilus podcast from, in my home office. And I reflect back on kind of the 2-year journey. Certainly got to have a lot more grey hairs since that first podcast, and the roller coaster that we've all been on. So anyway, today I thought I would just, start off by talking a little bit about the macro stuff, some of the funding involved, kind of behind the scenes, and then a little bit more about the actual uplist process, as well as the actual future outlook for Ilus in terms of dividends and further spin-outs, etc., etc. Now, I know very well from everybody's perspective, everybody's point of view, kind of we hear you loud and strong. The people want to see action, not talk, not hot air. Which obviously I'm hoping that you guys are starting to see that action starting to fall into place. If I refer back to our very, very first shareholder meeting and potentially even some of the earlier podcasts, we spelt out our vision pretty clearly. We are building a conglomerate, we're building a sustainable value business, a business that's going to build value for shareholders and generations to come. And these things don't happen overnight. And I know we have this, continual conflicting, let's say, approach, view, noise from the investor pools and shareholder base in general. Typical OTC, being pump and dump type of scenarios, which, is never, and from day one, we've been pretty clear on it. We're building a proper business, long-term sustainable business with real growth, with real shareholder value. When I say real shareholder value, I mean, going into the dollars, going into the billions of dollars, over the next 5, 10, 20 years, generational wealth. We are not interested in a 65% pump today so everybody can sell and take their profit tomorrow and leave the business behind. We are not just a ticker and a price. We are a real business. Behind our business, there's a lot of hardworking people, hardworking suppliers, customers. The team are absolutely dedicated day and night, sacrificing everything they've got to kind of focus on this mission that we're on. And I know from the same side from you, I'd like to thank you at this point. We're very, very, very grateful for the loyal shareholders that stick by us, through thick and thin, through all the noise, all the smog. We're very, very grateful for that, and we thank you for that. And it's for you that we work on a daily basis, day in and day out. Days and days and days away on planes and hotels, and travel away from our families, focusing on building this business for a common goal. So while we hear the short-term shareholders screaming for hype and screaming for pump, we're building a proper business, guys. And if you want to invest in a proper business that's going to create something long-term, we're the right investment for you, I hope. Certainly we believe you are. By the way, this is not investing advice. So let's reflect back from where we started this journey. And I think the market has this misconception, of where things are today. I'm not talking from an Ilus perspective. I'm talking from let's say a macro perspective. And again, in my opinion. So when we started, we were off the back of the COVID free money stimulus package, stimulus check boom. Where things went mental. There was so much froth in the market that things were not real, totally not real. But people got it so into their mind, and I mean this with respect, people who are uneducated on the trading floor, who are trading, off apps or whatever on their phone in their lunch break, and maybe don't have that experience, how to actually understand the proper business fundamentals, how to understand the balance sheet, how to look at growth opportunities, management team, etc., etc. Not purely just following the trend like a sheep in a Twitter group or a Discord group or a whatever group. With very little due diligence, and then complain when they lose their money. That huge, and that unfortunately is a big percentage of the investor pool. Now, I think we've shaken a lot of that out. Our stock was heavily focused. It was heavily loaded with that through the boom times, because obviously we were growing at a phenomenal rate. And if we kind of just talk that through in a bit more detail, somebody would put in $500 from a free check or whatever he got. Didn't have the expense because during COVID time, he wasn't going out, or he or she, so he, she, they, whatever you want to call it, just saying people in general. The people would get some money, throw it into a stock. Every stock was just going mental. They didn't have the expense at that time because of COVID, so they weren't traveling as much, they weren't partying as much, they weren't driving to the office. There was no tax and car and fuel and parking and all this. No, fewer dinners with their families out, etc. So people lived in this artificial world of, well, I throw some money into the market or into Bitcoin or into some random shit, some random shit coin. Things go mental. They turn their 500 into 2,000, their 2,000 the next day into 4,000. By the end of the month, they're on 10,000. 18 months later, they're sitting on 150 grand trading accounts. That person now thinks he's a legendary trader. Oh my God, look what I've done. Look how good I am. Meanwhile, the fundamentals weren't there for the majority of those trades. It was purely hype in the Twitter rooms and kind of the social media platforms. But that person got into their mind that their trading desk was worth 150 grand and they, blah, blah, blah. And obviously now that fat is gone, money's been pulled out of the market, the froth is gone, the foam is gone. We're now back to real fundamental businesses. And it's the real fundamental businesses now that now kick in. And the people that are in those real fundamental businesses are the ones that will benefit long term. And I know this may sound like, baby stuff to people, but we get it. We get this abuse on a daily basis from shareholders. What's happening with the stock? What's happening with the stock? I think now we've had that shakeout. We're now at a place where we can build solid foundation going forward. We've got a very clear roadmap, which we've had from day one, and we're following step by step. And those people that were sitting with 150 grand trading account across, 20 random stocks, most of them, they didn't even know what they were. They were just a ticker and a price. Those have all dwindled down to triple zeros or almost nothing left. And obviously now the pressure all comes on the companies. Well, it's the company's fault, it's the CEO's fault, it's the product's fault, it's the market's fault, it's SEC's fault, it's somebody's fault. The bottom line is, at the end of the day, real, strong, fundamental companies with solid foundations, solid management team, and a clear strategy, and the ability and the willpower and the determination more than anything to achieve and deliver. It's those companies and those stocks that will grow in the long term. Bull runs come, bear markets come. This is the cycle of life, and that will continue both in the short and medium and long term and forevermore. But if you think back to probably my last podcast earlier in the year, I said that we were really focusing in on building a sustainable business at the time. We were really focusing in on a strategic approach. We weren't just chasing after as many opportunities as we could. We were really focusing on how the financing behind these deals would work, basically tightening our belt, really focusing on cost control, consolidation, stripping out and becoming as lean as we possibly can, and really focusing on being able to provide the sustainable business for the next chapters, which is exactly what we've done and what we've been doing. So, and I know the market obviously takes this from a negative perspective because they don't hear as much hype. They don't hear an acquisition every month. They're not seeing growth that's shooting the lights out. But at times like this, when it's harder to get access to capital is harder, the market generally is tougher, and we've got a very clear game plan of building these subsidiaries and spinning each one out and creating the shareholder value, ultimately left with a conglomerate holding company, which is holding, hundreds of millions into the billions and, in the future, hopefully, worth of stock holding. And that's exactly what we're doing, and it's exactly what we've done. So, I'm sorry you're not maybe getting the hype and kind of all the, big blowout PRs that you were used to last year and the previous years. But I can assure you there's good stuff going on behind the scenes. The management team are working ferociously to get this uplist done. And while this uplist is done, parallelly the planning and preparation for the second uplist, the ERT one. And the team is really focused on that, because as those teams, and I'll talk about it later in this podcast, the access to capital for the bigger deals is really available on the larger markets, not on the smaller markets. That's really what we're gearing ourselves up for. So at this point, I'd like to say that yes, it's been a roller coaster, but I think and for certain, we're not where we would like to be on the share price. We're not where we would like to be in terms of liquidity and trading volume. But in terms of our operating business, I think we are pretty well off where we set out to be, in terms of our strategy and our roadmap ahead, and certainly our ability to deliver. We would like to have built our management team a little bit bigger, with a few more, highly experienced Wall Street professionals. But obviously that comes at a significant cost. So the timing has been critical of that. We've been really minimizing, trying to not load, additional cost, additional debt into the business at this point. Until we're able to leverage a little bit more reasonably costed funding and have the access to funding more freely available. So let me get on to talking about kind of the funding within the OTC space at the moment. So I just want to touch a little bit into the sort of the financing available in the OTC market at the moment. So again, the necessity for our uplist and our uplist strategy. And how that uplist strategy on a financial basis impacts and benefits Ilus, ultimately benefiting you, our shareholder. So what we've seen over the last, let's say 12 months-ish, maybe even going back almost 18 months, is that there's been a really heavy clampdown from SEC and sort of the regulatory bodies on OTC finances. I'm going to use the broad term toxic finances, but let's just say finances in general. Whether that's being hedge funds, small family offices, private individuals, financing, but essentially I'm talking about primarily unregistered funds of any description. And those guys, OTC has been born and brought up and grown up on that type of financing for the last, 20 years, 30 years, who knows. But typically those type of fundings were convertible note basis. And then obviously the S1s kind of, and the Reg A's, both tier 1 and tier 2. But obviously a typical Reg A or an S1 is a slow, expensive process. You've got to have auditors, you've got to have attorneys, The amount of management hours that it takes in preparing these things and kind of getting everything ready and put together takes a lot of time. And ultimately, it's pretty slow, both in terms of preparations, filing it, and especially if your business is not really well organized and doesn't have strong compliance. The questions and answers come back from SEC can take some time, which obviously stunts people's ability to raise capital or companies' ability to raise capital in a rush. When a company is looking to grow or has an opportunity come about, they need the capital, sooner rather than later. So hence the convertible note was a very common way for people, for companies to raise capital, and that's worked, let's say, relatively well for the growth of, the capital markets in the microcap space. However, obviously, like anything in life, people take for granted, and push the boat out too far, and obviously, hence the invention of the toxic note and the death spiral notes, etc., etc. We have the primary example when we first took over Ilus, where obviously we were involved in some of that stuff, which we inherited. However, that is those days. Thank goodness for us, it's gone. We're now in a nice clean financing type of arrangements, and all our toxic stuff is long gone. But obviously that continued in the market around us, and SEC has obviously been clamping down on those type of funders to protect you guys, the shareholders. There's been tons of guys and tons of lenders and companies with, someone with $6,000 notes and getting a gazillion shares, and adding no value back to the business, etc. So those guys have been clamped out, rapidly. You're probably reading about them, in all the other companies you're involved with. So those, that note lending is rapidly drying up. Off the back of that, the guys that have notes, the variable note, which essentially converted at a percentage discount to the share price, were really restricted out quite considerably, again, over the last 18 months, because from the SEC's perspective, or this is my opinion why they've done it, is that the investor didn't take any risk. Therefore, if it was 10 cents a share, they were making a profit. If it was 1 cent a share, they were still making a profit, because it was all percentage based. Obviously, that got clamped out to a fixed price shareholder, a fixed price conversion, and the alternate price was only allowed in under a default circumstance or under a specific defined circumstance in the agreement, where all agreements will have a reprice model in the capital markets. That's pretty standard because obviously it's a moving variable target. But in terms of the standard, note. But what this really meant is now people are sitting over the last 18 months that have got matured, 24 months even, that have got matured notes, are now sitting with paper that can convert at, let's say, 6 cents hypothetically, but the stock is trading at 3 cents, which means they can't convert out anyway. So they're now sitting with loads of paper, but very limited access of liquid cash. So of course, that's meant the toxic guys are gone. The guys that have got good fixed price convertible notes, good quality notes, are typically not able to convert because they're below the conversion prices on most stocks. I mean, pretty much every, I don't think there's any OTC stock that's doing as well or better than it was 18 months ago. Therefore, they're all underwater and can't convert and don't have the liquidity to lend back into the market. And simultaneously, the liquidity is gone because, refer back to the first part of this, this podcast, the amateur investor, the amateur trader, whatever you want to call them, that came in, with very little investing experience, opened a Robinhood trading account or whatever, and got going with $500 of free money, blew it up, didn't follow fundamentals, purely followed hype. Inevitably, they're always going to lose their money. I mean, it's like going to a casino if that's how you're betting. You're literally betting. You're not investing, you're betting. So inevitably, the house always wins on that type of scenario because you're not investing on any fundamentals. So those guys have gone, so that, again, that foam has gone out of the market, which mean, and those guys were the crazy liquid traders, they were trading every time I went up a cent, they were buying and selling and just taking their profits out. Those guys are pretty much gone now, between being wiped out by OTC markets, let's say squeeze, no, that's not the right word, but OTC dilapidation, and across their investments, because they're the same type of guys that are investing in crypto typically. So between the crypto wipeout collapse, as well as the OTC, with reduction, those guys are really disappeared or disappearing from the market. As sort of their trading accounts are just running down to very little. So that means the liquidity's gone out the market. So for the funders, for the small family office, hedge fund, lender, between having paper that's underwater that they can't convert out because it's below the share price, or just physically not having the liquidity to trade out, that even if they did convert and could convert, or agreed a reprice with the company to reprice and be able to get the stock, it would still take them such a long time to trade out, to get their money back, let alone reinvest. It means investment in the OTC in general has dried up, right across the board. And I mean completely across the board. Whether you're a fully reporting company, whether you are shooting the lights out with fundamentals, whether you are, ridiculously strong business, you've just invented the latest cancer treatment, it's difficult to raise money in the OTC space. And we knew this. Go back to my podcast earlier in the year. I predicted this. I said this would happen. Hence why we got ourselves in line to do this uplist at the appropriate time and get ourselves ready. Because the bigger boards are slightly different. The NYSE and NASDAQ, they're slightly different. They have a bit of different access to capital because it's institutional money. It's a lot of it is slightly medium, longer term view, as opposed to the OTC funder really, which is, looking for a 6 month sort of turnaround. They want to put in money today and sort of start to see money back in 6 months or even sooner in some instances. On the big boards, it's slightly different. I'm not saying quality of funding because that's not the right word, but a slightly different, let's say mindset or slightly different strategy of funding, which is why it's really important for us to get up to, the big boards as quick as possible and get access to that bigger capital. So that said, I know Brett Rossen gets a, hell of a lot of stick from our shareholders and from across the board, all the companies involved. I can't speak about the other companies he's involved with. It's none of my business. But I kind of want to just touch on it on our side, because us, including you guys as shareholders, we should be grateful for Brett right now. He's one of the few funders that is financing in the OTC space and continuing to finance in the OTC space and continuing to take risk in that space. And I know no shareholder, and bear in mind I'm a shareholder as well, right? No shareholder ever wants to give away tons of stock or any stock. No shareholder ever wants to see dilution, me included. However, what we all need to bear in mind is that for these lenders, money is their product. That is what they sell, money. So they need to be able to sell and buy more product and get more product and sell that product over and over again. And the companies need that product, i.e. we need money. So, that cycle has to go on. So although people don't like it when, Brett does a conversion and gets stock, not once ever to date since he started with us has he ever taken stock and not provided capital back to the company. Not necessarily immediately, but within a few weeks or a month or two. Most of the time he puts the money in long prior to any conversion. So never ever have I taken a call from Brett saying, Nick, can I please convert some stock? Never, not once, not one single time. It's always been the other way around, saying, Brett, we've got this debt, that's coming up due or is due, it's overdue, whatever. We need some capital. How about you provide us some more capital and, we allow you to convert one of your notes. And we kind of negotiate around those terms. So, on that basis, we should be very grateful that Brett has continued to finance us. His capital that he's put into both this business and into QIND is substantial. It's probably more than the majority of OTC companies have seen. And not one bit of it is toxic, not one bit of it is aggressive, and not one bit of it has come without added value or added benefit to the shareholders and to the company. It's allowed us to grow considerably. So I get pretty annoyed when I see kind of the continual, or I hear back from, the marketing team, the continual feedback and kind of abuse of Brett. Yes, we all get frustrated. Yes, none of us like to see. And yes, when we have those conversations, okay, you need some more stock, it's a depressing thought, but at the end of the day, it brings the light at the end of the tunnel and it allows us to deliver our goal. What we need to think, and I urge you all to think this, we are not thinking like an OTC company. We're not thinking of a 5 or 10 million. We're thinking 5 or 10 years out into the billions of revenue, balance sheet, access to capital. We kind of were very clear from day one. We kind of spelt out that our vision as Ilus was ready to go and to become a conglomerate, something like a mini Berkshire Hathaway over the years to come. So taking in some short-term debt, issuing some short-term stock to gain, if you look what we gained, we started from basically from zero to well over hundreds of millions of revenue now, and about to uplist a business which is going to add hundreds of millions of dollars onto our balance sheet. We can't really bleat and cry like babies over a $5 or $10 million worth of equity that a person has put in and not demanded back and been extremely patient with us. So on that basis, I'm not going to go on any more about it because I'm very grateful for the funding and thanks to RB Capital for the support on that basis. I know how you guys feel. And I understand how you feel. I sympathize with how you feel, seeing someone get stock and sell stock. But I would also urge you just to kind of do the mathematics on your basis, in your own time. So if you had, let's say, 50 million shares, and you sell 50 million shares based on our current liquidity, and our liquidity is not bad, right? So our liquidity, somewhere between 2 and 5 million shares a day. It's not the 10 and 20 million shares we used to trade, because as I said earlier in this podcast, the market's not there. The physical demand is not just there. That's not our stock, it's across the board. So if you work out, a typical, a guy that, or a person that is a fund that is caring about the business and the longevity of the business, which again, RB Capital does. They've got a huge amount of exposure to our business, and they get paid, they will get their capital back out of uplists in the future, which I'll talk a little bit more, in a while. So it's in their interest to kind of get us through the uplist process and get us onto the big boards. There's going to be very little OTC companies that remain on OTC that can pay back 10 or 20 million worth of debt. In fact, I don't really see any OTC company that generates that type of cash flow to be able to do that. Ours was always a very clear strategy. Our not exit, but our next phase was always to get onto the big boards. OTC was a stepping stone for us, which is what I believe it was designed for and what it should still be, and it is a very good place for that. I'd still highly recommend the OTC for a short-term stepping stone. But let me come back to the point I was making. If you look at our trading volume, a typical trader that would care about our business that's holding a big volume of stock would usually sell somewhere between 8 and 12% on a daily basis. So that might be up to 100, let's say 200,000 shares, maybe 300,000 shares, something like that on a daily basis. Gradually massaged and bled into the market without any, catastrophic effect on the sales, on the stock price. Well, if you work out, let's say 300,000 shares a day at 2.5 cents, whatever, you're still talking of small money, 6 to 8 grand a day worth of cash back. Times that by 22 trading days in a month on average, you look at how much cash the investor is getting back, i.e. RB Capital, versus how much cash he's putting back into the business. So typically we're obviously refinancing that Discover note, which we've paid down 3 payments. So we're glad to say we've got 2 payments left, and then Discover's out of our way. And I know those are not paid, they're paid off to Discover, which releases the senior secured position. And ultimately we just know we've swapped that debt out to RB. But they're long-term 2-year notes, which Brett wants us to pay back in future from the uplists. So they're not, we basically moved it from a relatively aggressive financing to a very calm financing that, we'll take care of once the uplists are done, and we can leverage our balance sheet in a much better, stronger way. But if you look at that, putting say 400 to 500 grand a month back into the business under new financing, versus what an investor would take out from selling 300,000 shares a day, you will see it's negative every time for the investor. So put yourself in the investor's shoes. If you were trading on a daily basis, on a negative basis, and knowing you're going to continue to trade on a negative basis for the short, medium term, how would you handle that? You would probably pull out of the markets like the majority of the lenders. Yet Brett is still there on a daily basis, supporting us and a number of other companies, and helping them to grow. Because Brett's vision is also medium, long term. It's not, believe me, Brett is not going to get rich on selling 53 million shares. That I can promise you for free at 2 cents, even at 6 cents. He believes in our long-term vision of building this business, creating the subsidiaries, growing the subsidiaries, spinning those subsidiaries out onto the big boards, and creating Ilus with a massive balance sheet, massive balance sheet that we can then raise such strong funding against, or even create small liquidity positions where we can dispose of small amounts of stock and pay back all our debt, which I'll talk about in a little while, because it's very, very important. It's kind of a part of our big term strategy. So I kind of want to just chat, sort of summarize and encapsulate that OTC funding space. And that's part of why you're not seeing, and I know you guys want to see it, but you're not seeing a ridiculous amount of growth and acquisitions being done from us or from any other OTC company, because the access to capital is not there. Acquiring a company is one thing. You buy it with stock, you can buy it with part stock, part cash, you can leverage finance it, take out some inventory finance against their receivables. There's a cocktail of funding you can make to try and force a deal through. However, if you don't have access to working capital after the deal, or even to execute the deal, and you don't have a longer term plan, you start to suffer. Refer back to my earlier podcast, I don't know, 6 months ago, I was saying we're really focusing on strategic planning and kind of a real strategic, sustainable growth plan. And that's what we've been doing. And that's exactly what we have been doing and will continue to do. Now, off the back of the QIND uplist and later the ERT uplist, we should go into a complete growth phase, an epic growth phase, which again, I'll talk to you about how that funding will work. But we should be going into a growth phase when other companies are still really, really struggling, which should really allow us to leverage on undervalued assets, which I'll talk to you about in a few minutes. So hopefully that's kind of encapsulated that the sort of OTC funding space. People talk about the market not being that bad, and it's this individual stock, or it's our stock, or it's that stock, or it's I think the market at the moment is kind of going through this. I don't know if it's completely in a bear or it's sort of trying to change its mood. Ultimately we're in a difficult time until I think there's change in America in terms of policy, government change, whatever that might look like. I think there's obviously inflationary pressure, interest rates pressure, the liquidity in the market. All of that has had a massive impact on the markets and will continue to in the short, medium term. How long, which is what I said in the beginning of this year on my last podcast, how long that's going to run out is hard to say at this point. I would certainly like to hope that kind of going into next year, it'll start to, really take an upward positive turn. But we sometimes say, well, people comment to us, well, no, the market's not that bad. Nasdaq's up, well, this is up, whatever's up. A lot of that is top heavy or overweighted. So what I mean by that is if you took if you take, let's say Nasdaq, for example, and you take out the top 10 stocks, the FANG stocks, or kind of all the big heavy tech stocks that have just become so massively huge and influential on the global platform, the Apples of the world, the Googles of the world, Meta, etc. If you remove those stocks, the Teslas, if you remove those stocks, the rest of the market is in a dire position. It's really struggling, and it's massively down from where it was 18 months ago. So when we say that the market conditions are not in favor, that's really what we mean. We're not talking about individual companies that Apple's having 0.5% up every day, only a couple of red days a week type of thing. We're not looking at those individuals. We look at it as a macro perspective. And if you look at the OTC, a stock will drop 6%, and then it'll have 3 or 4 green days. But the 3 or 4 green days don't equal 6%. Then it has another red day. It's this continual deterioration, as you've seen in our stock. That is not necessarily a reflection of any of the companies, the management, the ability of the companies. Across the OTC, I'm talking a broad spectrum. I'm not particularly talking about Ilus now. So those, as we feel the continual aggression and frustration and anger and sadness or whatever, disappointment, whatever you call it, from the shareholders, investor base, I would urge you to kind of look at the broader term. If you can show me, a range of your stocks that are up, dinner's on me. In general, it's a gradual deterioration, and that is a normal cycle for the stock market. It's the froth getting washed out. Maybe there's going to be another interest rates increase. Who knows? Hopefully things will start to get held by the reins a little bit tighter, and hopefully through the course of next year we'll start to see things come out the other way. But ultimately, as I've said 1,000 times before, good, strong, fundamental businesses with a solid game plan and access to real capital thrive and flourish in those opportunities because they're able to pick up really undervalued assets. It becomes a period of consolidation where the weaker companies can't survive and they get consolidated and merged into the bigger companies. And there's kind of usually a whole new era of large companies evolve out of the back of, I use the word recession, but I really mean kind of let's say a tougher time. We feel that we've got ourselves into that position that we will be able to be one of the ones who will be able to swallow up the weak and vulnerable, and I mean that with respect to them, and make bigger, stronger companies out of them, and really be ready for the next bull run, which will happen. I know when you guys go to bed at night and you look at your trading accounts and you're getting ping messages from your broker saying you're down and you've got a position to cover, whatever the case might be, rest assured it comes back. The market always comes back for the good stocks. So the only question you need to ask yourself at night when you go to bed is, am I in the right stocks? Am I investing in companies that have good, strong fundamentals, that have a good vision, that have a good demand? That's not just some artificial hype of an immediate wokeism, I don't know, some bamboo straw or some random thing that, it maybe has a short-term life. If you're investing in proper fundamental businesses, in my opinion, you're going to be okay in the long run. You're going to have some pain, you're going to sweat, you're going to have a bit of bloodshed, over the next year. But in the end, you should come out in a really good position. Anyway, I leave that thought. And again, guys, this is not investing advice. This is just my personal perspective. And I'm going to go into some a little bit more interesting topics for you. So I'm going to talk to you a little bit about the exciting part of this next short-term chapter, the uplist. And I say short-term because it really is short-term in the life of the business, although it may feel like a lifetime on a daily basis. Certainly does for us. So just to talk through the steps, it's reiterating what JP already said last week in his podcast, Vodcast. So the 10 Qs filed today for QIND, the 10KT will be filed. We're aiming for some point next week, hopefully in the earlier part of the week, but we're certainly aiming and doing everything we can for next week. And I'll say this out loud, guys, it's not in our interest to delay this. So while you guys get frustrated about any delays, so are we. Believe me, the team work day and night to get this thing done. We want to get onto greater things of growing the business and doing some more acquisitions and getting some more stuff done and get the ERT spin-off underway. So we want this off our desk as fast as possible and let the banks and the professionals get on and do what they've got to do. So we certainly have no interest in delaying this whole process. So, I get that out the way. So 10Q today, 10KT next week. And let me just sort of talk you through that. That is not an SEC requirement for the S1. That is to do with what they call a seasoning rule by NYSE. So what that really means is they want to see a full year after a major acquisition. And obviously, Quality is a major acquisition for us, which was done at the end of June last year. And therefore, we don't want to hit the stumbling block. And I think I've said this to some of the shareholders that I've spoken to on a one-to-one basis. We're trying to get all the hurdles, obstacles, trip hazards, potholes out the way in advance of us going to the next stage. And I think and we might take criticism for that, but we would like to think down the line, everything becomes much smoother, where a lot of companies are very quick and kind of get led, as I always say, the tail wags the dog, get led by the shareholders to just get it filed. We could have filed our S1 3 weeks ago. The S1 has been sitting totally complete 3 weeks ago. So it could have been filed. Then we would have had 10 comments, 20 comments, and all these trip hazards. And then you guys would have come back annoyed at us because it's now taken 60 days to become effective. And ultimately, we just wasted everyone's time and frustrated everybody and have the roller coaster of the share price. So we've got kind of probably the best experts available in the market to us who are working on this case with us. They're probably some of the most seasoned executives in this space. So, we would like to think we've got the best counsel available to us to kind of get us to make sure that these trip hazards are dealt with prior. We are seeing that the SEC is dealing with a lot of the S1s are coming out with no comments, which is obviously a big part of our goal to get this thing through as quick as possible. And therefore, please be patient with us with a few days here and there because it will save weeks later. So the 10KT we know is a seasoning rule by NYSE where it requires us to have a full year's audited financials after a major acquisition, a material fundamental acquisition, which is what's happened. So if we had filed our S1 2 weeks ago without changing the financial year end, it's highly likely S1 would have been approved because it's not an SEC requirement. It would have gone through the NYSE and they would have spat it out and said, you need to file a full year's accounts, come back in June. June's already passed, but our financial year end was December, right? So we decided to change our financial year end at this point in advance, get that done. So it meant we had to audit an extra quarter, which has been done, complete, but obviously that added a week or two to our timeline. So that's been done. S1 is updated, so we have to file another 10KT, which is sort of an extra quarter onto the previous 10K. That should be filed next week, hopefully. And then the S1 will be filed shortly thereafter. So as I said, the S1 was completed 3 weeks ago. So there's obviously some updates that have to be done, some small amendments here and there because of the 10KT and the change of financial year end, some slightly change to the consolidated numbers in terms of the timing. But ultimately, the backbone of it is done and ready to go. So as I said earlier, it's not in our interest to delay this. We want this thing done as quick as possible, but we also want it done as quick as possible and a green light and a green flag and get told go. So after the 10KT next week, hopefully, then we'll have the S1 very, very shortly after. And then we kind of go through this period of SEC. Parallelly and simultaneously, we go through the NYSE application. And then once we are cleared of all comments, which we're not saying ours is going to be, but we hopefully, we can get that done within 30 days. A lot of the S1s that are well prepared and well done by the major law firms like ours are going through that sort of time period. Ours is actually not a complicated S1. We're not reliant on patents. We're not reliant on medical trials. We're not reliant on 100 different risks. We're actually a relatively resilient business with a huge order book, proven business, proven customers, so we actually, I'd like to say, least risky than the majority of the businesses that go through these process. So we're hoping our S1, being well prepared, won't, have any stumbling blocks, so we get no comments quickly. Can't promise, but that's our aim. Once it's got no comments, we quickly wrap around our roadshow. There's about 200 investors. They group together by the investment bank. Roadshows these days are all electronic. So we basically whip through the roadshows in a few days to a week / week and a half-ish. And as I said, they group together. It's not 200 individual calls. And then basically we're good to go after an effective data set and, whatever the numbers might be for regarding the reverse, which we're hoping is going to be as least as possible. Again, not in our interest to do a big reverse, right? The least reverse we want, the better. And then we're good to go. Now, we're obviously hoping, again, in my opinion, not investing advice, we're hoping that as we sort of come up to that period, as the S1 comments are cleared, that we should start to see, some strong volume and some strong buying into QIND, as well as into ILUS, because obviously the ILUS shareholders get a benefit out of it, and at a certain date, on a certain point, will be sort of the cutoff that shareholders at that point, shareholders of record at that point, will then gain, some dividend shares. And obviously, we also have the lockups and other things around ILUS, which we'll talk to you about closer to the time. I know you've heard that 1,000 times, but these things are really fundamental, that they're done at the right time, not upset the apple cart, not, cart before the horse, and we kind of make mistakes and we say things we can't deliver on. So that's really where we are in terms of the uplist timing. Now, that's really important the uplist is really important for a number of reasons. It's not about whoopee, we're on NYSE, we've got a big board company, the stock's trading at $4, $8, $10, whatever the price might be, which we've seen some relatively successful ones recently. If we look at the fundamentals, we are considerably undervalued. So one would think, reverse or no reverse, you would think that once it goes up to NYSE, the institutions who are much more analytical in their approach would see that we've got a several $100 million order book, major clients, big oil firms, big blue chips, including American, British, and European oil firms. We would think that, that uptake and that gap in between the current value and the real value would be, swallowed up relatively quickly. Again, this is not investment advice. This is our opinion, or my opinion anyway. So, but it's not about that. What it's really about is, if you think back to the ILS, our plan of building a conglomerate. Conglomerates need money to grow. We acquire, we merge, we consolidate, we organically grow, we cross-pollinate, and we grow the subsidiaries huge. The bigger we can grow them, the faster we can grow them, the quicker we can spin them out. And at some point in the near future, ILS on its own will be strong enough to uplist on its own, where by that point it is holding a whole bunch of big board stock in real value. I'm talking hundreds of millions, hopefully even billions in the medium term, medium long term. Therefore, what this really means is our access to institutional funds in the subsidiaries becomes strong, which means, so we uplist QIND. QIND, yes, it takes on 7 million, which will be an underwritten offering after the comments and after S1 becomes effective. That underwritten offering is guaranteed at 7 million by the investment bank at that point. I underline that at that point. But the noises are all going in the right direction. We're pretty confident in that. But once we are on the big board and the stock is trading relatively well, which we hope it will, and we're trading at, whether it's $4, $6, $10, irrelevant at this point, we're able to raise a blend or a cocktail of funding much easier in the big boards. So whether that be a combination of debt finance, trade finance, straight up equity offering, convertibles, because in the big boards, they're doing good quality convertibles with non-toxic terms. Those terms are available in the big market, much more freely and much betterly available than they are in the OTC space. So, we've heard a lot of people think, oh my God, you're going to do the 7 million, you're going to take a massive dilution, then you're going to do another offering. And yes, of course, there's going to be ongoing offerings. Nobody goes into the public market for fun. We go into the public market to raise capital, to add shareholder value, to grow the business. And for every dollar we borrow or take on of dilution, we should be adding several dollars to the shareholder value. Maybe not immediately, but over time. And that's obviously up to you guys whether you believe in the management team and the strategy of the business. But that cocktail of funding and the blended funding becomes seriously important, because after we've done the initial offering, within a day or a week or a month, being on the big boards with good liquidity and a good share price, we will be able to now have access to this blended funding, which will allow QIND to grow at a ridiculous pace. It's got hundreds of millions of dollars of physical orders in the books. It's got billions of dollars in the pipeline. So the pipeline is huge and doesn't all funnel through to orders, right? And it takes some time. But with more access to capital, we'll be able to grow that much, much quicker. As we've spoken of before, there's potential of 2 other acquisitions to come back into the fold after the acquisition, after we uplist, after that's all done. So we've said it before, we're hoping to grow that business, QIND, we're looking to grow that to billions in the medium term, not long term. I'm not talking 5 years out, I'm talking 2-3 years out, by a combination of our current strategy, merged by acquiring, consolidating, and growing. So now what does that mean? So QIND is straightforward, right? We uplist, we're able to raise capital within the company, and able to take on those, grow that pipeline and grow the order book and continue to deliver. And that's not all on an offering or a registered offering or an equity basis. It's a blend, right? And that's important to understand. In the OTC, it's very difficult to get blended financing. Very, very, very difficult, or leverage finance, or any sort of cocktail, because most of the funders in that space, the small private offices, family offices, etc., hedge funds, non-registered hedge funds, etc., don't necessarily do proper AR funding, don't do proper asset registering, asset funding, don't do, the convertible note market, as we said, has shrunk. So it's very difficult to get that cocktail of funding. And then any note provider now takes a senior secured position, which means that the AR is already gone. AR meaning age receivables, so kind of your money that's owed to you has already been effectively sold to the convertible guys, and it becomes really difficult to get any blend of financing. You're really left with one-dimensional financing. You either take a note or you take dilution. That's more or less it. The AR financing is becoming a bit more common now. That's really the bottom line on OTC. The big boards is totally different. There's specialist funders in all of those spaces, all of them. Whether it's AR, whether it's leverage, whether it's assets, which allows you now to put together a much more aggressive acquisition target, much more aggressive growth plan, because you're able to finance it much easier, much quicker, much more affordably, on better terms with a more long-term outlook. But what does this really mean for Ilus? Because this is not a QIND podcast, this is an Ilus podcast. So what this really means for Ilus is the following. So first of all, we're not intending, and we certainly have no ambition, and it would be stupid for us to expect that we're going to do this first round and lose control of the company, which we've seen floated around on various different Twitters and social medias, and we're getting emails and WhatsApp messages and Signal and whatever else about, come on guys, let's be real. We don't work up at our butts off to grow this business to give away control at the first step. Of course we don't. And we've got a plan, we've got a structure, we've got a strategy around how we would raise that capital without too much dilution at this first phase. And as we've said before, kind of as the pie gets bigger, yes, everybody's piece gets smaller, but the pie is bigger. That, really that is the fundamentals behind it. So if we just keep the numbers as they are now, and don't quote me on the exact numbers, this is kind of, I'm trying to give you an idea of how it could work for Ilus, and how, what some of the stuff we've got in our mind. So let's just say Ilus owns, and I'll kind of ignore the reverse part or split part of it, just looking at high numbers. So Ilus has 77 million shares, which are relatively or totally illiquid on the OTC market. However, on the big board, they have a real value. Those shares are worth a real price. Banks will lend against it, or some banks, boutique banks, will lend against it and collateralize it. We have the ability, because it's a strong, hopefully there'll be a strong demand for the stock. So from an Ilus's perspective, if we wanted to, and I'm not saying we're going to, don't quote this, but if we wanted to, let's say hypothetically, let's say, the shares were, I don't know, $4 a share, we wouldn't have 77 million, so obviously there'll be some type of reverse. But let's just say hypothetically, and don't quote me again, let's say it's a 2 or a 3 to 1, something like that. We might have 35 million shares. We theoretically could pledge 2 million, 5 million shares, whatever, to a boutique bank to take in really well-priced capital to be able to pay down Ilus's debts. And if you recall back to what I said earlier in this podcast, Brett wants to be paid back. He doesn't want to be converting out stock selling at 2 cents. His funding at the moment is a means to an end for us to grow us, to get us to the big boards. That is his strategy. So he only converts the minimum that he needs to, that we need him to. So we'll be able to take in that capital and pay down our debt. So the swapping of our debt from Discover to RB and, parking it back a year or two on a new note is good for us, because that means once we up, we've got access to a different range of capital to be able to pay down those notes. And Brett's finance is not expensive. It's 6% capital. It's very, very, very affordable money. And we know he's not going to convert from under our feet, which means as we get stronger and stronger on the big boards, the Ilus stock on QIND becomes more valuable, both from a lending perspective. We can collateralize it if we really wanted to and we needed to. Ilus had a massive opportunity that it wanted to take up. We could potentially liquidate 1 million shares or a small amount of shares, and if it's $4 a share or $8 a share, $12 a share, who knows? It's a real amount of money. 1 million shares at $8 a share, it's a serious amount of money in Ilus terms on an OTC company. You can imagine, let's just say, I'm just putting this out there in inverted commas, let's just say, and again, I'm not saying we're doing this because it's not our plan. Our plan is to hold control and as much of the shares as we possibly can for as long as we can. But let's just say hypothetically we sold 1 million shares at $8. We'd pay down almost all Ilus's debt. Ilus would now be sitting owning a huge portion, still complete control of QIND. By then, ERT spun out a huge percentage of ERT, which would be the same sort of numbers, and be pretty much debt-free and have access to capital. And at that point, the current OTC guys will be bleeding. The market will continue to be suffering because it's not going to just come out of this, this bear market through next year. So theoretically, our opportunity then to grow and swallow up, those, say, weaker firms should really come into its own. And then our roadmap really becomes clear for our investors. And we know, guys, we're very, very, very conscious of it, that you hear talk, you hear hot air, you see hot air, you just want to see results, you just want to see it done, you just want to see it on the scoreboard. So do we. And believe me, when JP's waking up at 3 o'clock in the morning, that's all he's imagining, is getting this bloody thing done. When I'm waking up at 4 o'clock in the morning, that's all we're imagining, is getting this bloody thing done as quick as we can. So, please don't think we're sitting with our feet on the desk waiting for greener pastures, because those greener pastures are not coming in the OTC space. As I said earlier, we've got a really good strategy, and we believe we're on track to deliver that. And that's why this first uplist becomes so fundamentally important. And Ilus is roadmap, because it gives us that access to capital. It gives us that collateral. It gives us that access to liquidity. And because we've got good quality funders, we should be able to make the most of that. Now, on the same boat, it's not one. So that gives Ilus shareholders some dividends. And at the same time, going forward, we have an ERT one. The access that Ilus has had to capital, it allows us to grow Hyperion, Replay, eRaptor, and some of the other businesses. And all of those businesses have got $100 million revenue potential of their own. And they don't take a lot of money to grow. The way they're structured, they're lean. The way they're structured, we should be able to grow those relatively quickly, which means it's a QIND uplist. Shortly after, 3-6 months later, it's an ERT uplist, a 4th uplist, a 5th uplist, a 6th uplist. Meantime, by then, we're now on the hunt for more acquisitions and more valued assets. So this conglomerate, you can see how it sort of starts to form its way out. But we know, coming back to the basics, it's about delivery on this one. We're well aware of it, and we're doing everything we can. We've spelled out the timeline. JP spelled it out last week. I spelled it out this week. It's now short term. We're now no longer talking medium term. We're now on the short term. It's now on the immediate horizon. So I will move on from that topic. Hopefully that's given you, a good picture of where we are. The lockups will be discussed closer to the time. The dividend for the shareholders of Ilus, shareholders of record at the time, will also be, explore, sort of, let's say, discussed it and kind of extrapolated in a little bit more detail for shareholders, in the coming weeks, and kind of as we come into that uplist. So, there we are, guys. I will wrap up that topic now and move on to, some more interesting topics. So obviously you've seen it PR'd, we've put it out in a PR, we've discussed it in various podcasts going back 18 months again. Now, our vision is not reactive. And I think part of this, partly it annoys some of the shareholders because we don't react to, to the hype or to the, demand for information. We have a very, very clear vision, very clear roadmap, and we're delivering on that, and we'll continue to deliver on that. And JP and I will sit with our foot up everybody's ass until that gets delivered. And we do not stop. Losing is not something, I've said it 100 times on my podcast, losing is not something I take lightly. It's not something I enjoy, except I'm a pretty bad loser, and I'm, pretty blatant about saying that. I play to win, and I play to win at all costs. That is just the way I'm wired, and luckily, that is the way JP is wired as well. And most of our board, including Carsten and Louise and Murti, we all wired the same way, which is why we're driving this company forward in such a successful way. And I know it doesn't feel like that. You guys have a different scoreboard to us. You look at this, you look at the share price, and you look at your trading account, and you go, oh my God, it's doing horrendous. And as I've said, it's about fundamentals of a business that's growing and kind of got a long-term plan. And we'll continue to strive to deliver on that. We will not let the tail wag the dog, and I mean that with respect to you. So just because the shareholders call for some crazy hype or some instant demand on something, if it's not part of our roadmap, we're not going to divert from our parallel tram lines. We're very clear on that. We have open eyes and kind of a broad peripheral vision on opportunities that may present themselves for shareholders, and we make ourselves available for those opportunities. But that said, we've got a very clear roadmap. And if it doesn't fit in our strategy, as good as it might seem, we're not really interested right now. Things may change when we have a broader access to capital. We've got a much stronger balance sheet and a much kind of bigger base and more bandwidth as a management team. If the market would continue as it was 2 years ago, we'd probably have another 4 or 5 bodies, maybe even 6 or 7 bodies on our core management team. But the level of management that we need are expensive, highly experienced, highly skilled, share the same vision, not easy to find and not cheap. So it's all about recruiting them at the essential time. And I know we've spoken about recruiting for CFOs and COOs and kind of for the particular companies. How we kind of play that out is as each company gets uplisted, it really needs seasoned experts in that particular industry. And I think hopefully, your shareholders will take some reassurance in this. JP and I don't profess to be oil experts at all. And we don't even profess to be NYSE experts at all. We are business experts, and that we, quite happy to say confidently, and quite, we like to say confidently good at achieving and doing what we need to do and breaking down walls and not taking no for an answer till we get to our goal. But on that basis, we're very conscious that as that uplist happens, concurrently with the uplist and sequentially after the uplist, we need to have seasoned Wall Street professionals on the board. We need to have a CEO in place who's got oil experience. We need to have a CFO who has COO who have oil experience, Wall Street experience, big market experience, who can now take that business from a few $100 million market cap up to $1 billion over the next 5 to 10 years. We're now no longer playing with the goldfish in the small pond. We're now wanting to go into the ocean and kind of swim with the whales. And for that, we need the experts. We know that. We're well aware of that, and we intend to do that. We're recruiting, we're hiring, we're interviewing, we're finding the right people for the right money, and importantly, hiring them at the right time. We don't want to load, the companies with those massive costs right now, which they can't afford. So it's all about timing on that. So coming back to my point on this particular, section of the Vodcast is about the ERT uplist on its own and kind of our immediate steps. Now, we've got a bunch of companies that are able to be uplisted or have the potential to be uplisted over the next 12, 24 months, that being eRaptor, which can grow globally into hundreds of millions of dollars on its own. Obviously, it's a non-event right now in terms of its scale and size and ability. But as we have more access to capital, we're able to grow that quickly. The technology is fundamental. The product is great. The Serbian relationship with the government is going great. So on that basis, eRaptor has potential. Replay on its own has potential, which I'll talk to you about on another podcast another day. We really focus on what we're doing. We kind of don't want to detract to what we're doing and distract the market just purely for the hype, because we just get shot down from everybody else. Let us deliver on this. Let us get this flag on the ground. Let us get on the big board. We're talking weeks now, not months, hopefully. Or certainly if it is months, it's not more than 1 or 2. 3 at a very, I don't think it's going to be 3, so let's not even go there. Point being is, as those companies grow, slowly will the experts be brought in to grow and develop those companies, i.e. Dan Peters. Some of you met at the shareholders meeting. He's obviously on board for the ERT business. As we said, it's finding the right people is difficult. Dan Peters is one of the right people for us, hence why we took that opportunity to hire him early. And thanks to you, Dan, for kind of the hard work and sacrifice you're making. Working on a baby boy's salary at this point, and we appreciate that very much. And I'm sure the shareholders would like to thank you for that too. But as we grow out this, the ERT business, what's really going on right now on a daily basis is we're starting to consolidate. So just so you know for the timing. So we're consolidating all the fire and rescue businesses into ERT. So ERT is a subsidiary under Ilus. So Georgia Fire is going in there, Bullhead's going in there, AASS is going in there, Firebug is going in there, BCD is going in there. So we're consolidating all those into a new set of financials. within that ERT business, which is under Ilus, again, 100% owned by Ilus, that those consolidations have to get a consolidated audit, which we're physically busy with right now. So once that is done, then we'll be able to basically start to work for the ERT uplist, which is really pretty much a repeat of what we're doing now. Coming back to how I spoke about the finance in the first section of this podcast, our access to capital is important. So that ERT business, we would intend to acquire. We've got 2 opportunities, both which are verbally agreed. We can't sign letters of intent because physically we can. But if we sign letters of intent, it'll slow the uplisting process down, because SEC, once we physically sign something and we kind of legally bind it to it, SEC wants to know everything about it. What are the risks? What are kind of the upsides, downsides, audits, all that stuff around it, which obviously we don't want to delay any uplisting potential by 1,000 questions for something that we could easily do straight after the uplist. But there's 2 acquisitions. One, which we've spoken of, for a year, 18 months. We've physically known the CEO for, I don't know, maybe 10 years. JP's probably known him 7, 8, 9 years, I don't know. They got a large wildfire business in Spain, operation in California, something in South America. Seriously strong business, growing at a phenomenal rate, really around the wildfire space, which obviously is the hottest topic and will continue to be the hottest topic for the next foreseeable future, with global warming and all these type of things going on. So, and people's habits changing. So we would look to acquire that business, and we look to acquire the US business that we've spoken about before. It's an emergency rescue vehicles business in Florida, manufacturing. Last year it did close to 60 odd million revenue. It's got $150 odd million worth of order book. Very strong business, seriously strong business. And we would look to really acquire those 2 businesses into ERT, whether we acquired them both prior to the uplist or acquired one and then uplisted and acquired the second. We're still working through those fundamentals. But those 2 businesses with our current offering would give ERT a substantial revenue, substantial balance sheet, and would allow us to spin that business up to, onto NYC pretty quickly. In terms of the timeline, because I know that's all you guys are interested in, kind of the dividend that you guys will get at the end of the day, they're pretty much running parallel with what we're doing with QIND at the moment. So the team are consolidating financials, getting all that stuff ready, so that we could move into an S1 pretty quickly on an ERT position after the QIND is done. So our vision really is QIND, flag in the ground, NYSE up, done, new board, and some senior execs onto the QIND board, let QIND run. Ilus organizes some refinance out of off their collateral. Ilus then is able to refinance its debt pool and also kind of strengthen all the operating subsidiaries with working capital so it can drive itself forward. Simultaneously, the team now focused on the ERT uplist, which really is accelerating the financials, audit, S1 prepared, and basically getting that ready to spin out an uplist. It's that simple. It's really a copy and paste of what we're doing at the moment. Now, there may be, some slight differences because we haven't acquired those big businesses yet, and so there's going to be some slight variation, but essentially the process is fundamentally the same. So it's a carbon copy and paste. So once we've done this one, then that one will be up. ERT will be up relatively quickly after QIND, I say relatively quickly in the medium term. Let's say it's 3 months, 6 months out after QIND, but either way, it's not a long way out. Again, dividend for shareholders, stronger Ilus balance sheet. Ilus has more access to capital. Meanwhile, we've been growing Replay and eRaptor aggressively, and Hyperion, and hopefully acquired another chunky asset, which we've just started early discussions with. And then there we go. Kind of then you can see how the copy-paste model goes. QIND up, ERT up, eRaptor up, and slowly we go for the next 2 years, just pushing out, incubating, and growing out our own subsidiary companies. So hopefully it kind of, again, gives you some idea of the timeline behind that, and what that really can mean for you in the future. So Ilus looking forward, huge balance sheet, liquid assets, strong capital base, access to capital, strong, exciting subsidiaries that can grow, strong boards running each and every individual company, and effectively the beginning, what we like to say, the beginning of the delivery of our roadmap. You guys may say our roadmap started a year ago or 2 years ago, so at our first shareholder meeting. Sure, the roadmap started, but we're really, after this QIND uplist, we'll say now our game begins. Now, for the first time, we now believe we're now on the map, on the way forward. All this pre-time, we've basically been building foundations, laying out the steps, laying out what needs to be done, and getting ourselves ready for the big time and the big lights, which is really where we've got to. So, I'm going to leave it on that. Sorry, I know it's a super long podcast. I hope it was useful. I hope you found some interesting stuff from it. And I thank you for your support. I thank you for your loyalty through these tough times. I know the market is pretty horrendous. I assure you our business is in good condition, good shape, and we're really geared up for growth. And we are focused on a daily basis bringing you value to the shareholders, and it's you that we work for on a daily basis. So I apologize, for any frustration you might feel, or any fact that it's taken so long. But I assure you, your best interests are in our interests. So I will leave it there, and thank you for your time. Thank you for everything. All the best.
I like the intro and outro music. I got it. All right, so that was loaded, and so guys, Rob's going to put the Ilus Discord and the BFC Discord in the comments section. So join both, seriously. And anybody that is in the BFC Discord, the young BFC Discord that producer Rob made me launch. He's like, you got to do a Discord. Well, I did, and that was loaded. All right, so I was watching your thoughts. There's 27 of us. There were 30 on at one point. Thank you to everybody that was jumping on and watching with me. I appreciate that. And I'd be a liar if I said I wasn't watching my own show, doing the dishes, watching with you guys, and I just hop back up in here. But there's a lot. There's a lot there. And so, like I say, my conviction is strong with this company. Anybody that has followed me over the last 2 years knows I have not wavered here one bit, and I will not. I refuse to. So, I mean, that's just where I'm at. And so let's talk a little bit. He did talk about lending drying up. He did address the fact that it's extremely hard at this moment to get funding for the OTC. But what Brett Rosen has done is absolutely huge. So when you see this guy being attacked left and right, and he is the normal target. He's not cashing out his shares, not dumping shares. Like he said, it's not valuable for him to drop his shares at 2 cents. Trust me, Brett is in it to make much more money than that. He's not buying and sharing. He's not buying and selling shares and releasing them for 2 cents. He wants to make money. We're all in this to make money, and so I'm pretty excited for what I mean. Like I said, if you think this is not the only time I will have watched this. I'm probably going to listen to this podcast a couple more times. What was really, really cool was like the insight he gave into the insight he gave into the QIND uplist, and basically comparing that to ERT. Now there were rumors going around that Dan Peters isn't with the company, and maybe he left or yet. No, obviously things are still progressing. I thought it was really cool how he mentioned the fire vehicle manufacturer in Florida for ERT. I think that's absolutely awesome. And this is one thing I want to say though. I want to say this. Jordan Hugga, get your ass on the show right now. I sent you a link. What I will say is that they're talking for every one of their subsidiaries, practically hundreds of millions of dollars. We're focused on QIND. QIND, I know people feel like QIND is getting all the attention, and maybe there's a little jealousy there. I don't know. Guess what? I'm telling you, I don't even own QIND. I just, if I'm going to buy, I'm going to buy Ilus. I might buy a couple shares of QIND, but I'm involved. I'm invested in the parent company. When I hear good things happening to QIND and that they're on the verge of this historical uplist, I am actually, I'm ecstatic. Now when I know that they're going to apply the same, oh wait, here he is, and they're going to apply the same formula to ERT, that even makes my day. That makes my day. And I think they're going to do it with Hyperion. They're going to do a replay. Jordan Hugga, welcome to the BFC, bro. Don't do this internet thing on me. Don't do the internet thing. He's muted. Oh, well, I'm just going to keep talking. So I thought that was really interesting. If he ends up on, just to interrupt me, Jordan, if you could hear me. I do believe the ERT section is going to be huge. It's going to be absolutely huge. And so I don't know. I think that they're making a lot of progress. I thought it was interesting him talking about the S1. I thought that was absolutely huge. And you want them to get the funding. And so they're going to get the funding. And like he said, they may not even have to do a reverse split. It all depends on the funding that they're going to get. And, he did talk about this in a video prior. About how basically about the macroeconomic conditions. He did. He laid it out and he called it right. And this was about a year ago, or maybe it was November, December, sometime around there. That was quite a long time ago, but he did discuss that. So, But yeah, so I'm pretty happy with that. I'm gonna watch it a couple more times just because there's so much information, and I like his the vibe he was giving out today. So, what are your thoughts? I know you guys have been sharing along the lines, all 28 of us here. I don't know. Sunballer, what's up? You do. I see. I remember him talking about that, and so it doesn't. And he said, I took down a couple quotes that the market's going to reward good companies. Oh, you're there, Jordan Huggy. You're there. You're on mute. Are you on mute?
Yep. Can you hear me?
Oh, there, baby. What's up?
Nothing. And I even got the internet, although I had to. You can't hear me?
No, I can hear you. I can hear you.
Oh, okay. Yeah, I had to roll around until I found a internet connection, and it was very difficult since I was like about to faint or pass out. As I had people coming up and talking to me and trying to call me, and I was like, "Nick's talking. Stop."
Oh man. So I mean, overall thoughts. I mean, dude,
that was pretty incredible.
Dude, that was a loaded video. Like I'm trying to like sum up. Like it's hard for me. They are not your typical OTC company. One, they're talking about hundreds of millions. They're already $250,000 in assets. I mean, it's almost like I got to sit down and I'm not even joking, guys. Redo my Ilus DD because it's like they have so much going on and so much in the pipeline, and their balance sheet is going to be. It already is bigger than most OTCs. And it's almost it is overwhelming as a shareholder. You're like, because as I'm listening, I'm talking, I'm like, oh, whoops, I forgot about that. Whoops, I forgot about that. I mean, it's crazy, dude. What was your what was the juicy nugget that you really, really liked?
Honestly, there wasn't one single nugget because, like you were saying, there's so much information. I was actually just breaking it down and saying, okay, I'm going to actually have to do like 5 different lists. And then what I'll do is I'll just watch it all again. And then when I'm watching it, put each individual detail in its appropriate box. Whether it was ERT, QIND, medium, long-term funding. The big takeaway, besides the fact that, of course, it was great to see and hear him, but it's really difficult, especially when there's no obvious reasons why, the share price is being affected. So I'm really glad that he addressed that too, that it's very difficult to have faith or to have any belief in these companies moving forward. When, again, like everybody says, every single OTC company, they're all basically, scams and just bad companies to begin with. So when I see them come on and do this, again, I don't even need another follow-up video after this. I'm basically good to go to the uplist because I already knew what was going on, which is a bunch of things going on, behind the scenes that they're not really addressing, and there's not really much they can tell us about it, but it's all very necessary for them to do what they need to do, towards their uplist plans. And I know other people had brought up, and I believe it to be the case too, is that some of the fudsters will say, oh, well, Dan Peters is no longer with the company or blah, 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 or whatever, because apparently you have to send them an update with your signed documents and a picture of you holding your license, having it all notarized. When I think the reason that that's actually happening is that, like Nick was kind of alluding to, they're basically uplisting ERT in parallel, and they can't really talk about it with it's going on, but that we can expect it in short succession right after QIND. So to me, the only thing I'm really dying to know right now, other than all those little juicy details that I couldn't absorb on the first listen, is what the data record's going to be. Because they've all listen, the plan has been spelled out, right, and they keep reaffirming it with details. The last one being the QIND and ERT shares that we'll be receiving. So there has to be a date of record. We don't know when that date's going to be. The assumption is going to be that it'll be a date in the future, which usually drives FOMO and gets people to want to buy in because they like dividends. But again, we don't know what the plan is. We don't know what their creative financing solutions are going to be. So yeah, I'm overwhelmed in the best possible way. What a great way to start a weekend.
Yeah, it is a great way to start a weekend. And I did like how he said, Dan Peters, for the work he's putting in, is working for peanuts, and they're going to work their asses off to literally secure those acquisitions, even though they can't file the paperwork yet for some of these things, just because of the timing, and they don't want to screw anything up. And I hope they don't, and I hope they keep doing what they're doing. I did like the fact they talked about basically once QIND is done, once all these acquisitions happen, the second acquisition, which you talked about, they're talking about paying off the Ilus debt, and I think that is absolutely awesome. I think it's great. I think that's one thing that you don't see people, tackle. CEOs often tackle and say, all right, we're going to clear our debt. I really think they want that Ilus uplist to be as nice and sexy as possible.
Did you? I'm sorry to interrupt you. Did you see Sam's last video there for QIND?
Yeah, and by the way, you know what? If you haven't, I actually retweeted it. I watched it. It was a meaty video, guys. This guy, if you want due diligence, follow Sam Aker because he breaks down, and he's on the show often. I was actually just talking with him yesterday, and he breaks down the filings, the skeleton of these companies, and so he breaks down the filings to break down the 10Q, the 8K. He'll do all that stuff, and so yeah, and he actually texted me yesterday, and he was shocked about Rickers. We'll see you later. But yes, there it's on the big screen again, Rickers. But he did talk about the fact that they're going to be paying off the QIND debt, basically like they're using the profit, they're using everything that they have to pay everything off. And he's like, wow, this is a really great thing. I go, well, yeah, I think that they're doing the right thing. And one thing, did you see the tweet from Ilus Marketing? I thought those were great pictures. I showed them earlier in the show of the Serbian facility. And that's another thing we forgot about too. We got eRaptor and all this cool stuff going on. I mean, there are so many. I mean, under the 4 divisions, there are so many things going on. And if you're new to Ilus, I think it was JD. He didn't know of was it JD? Click on the Discord links and join the Ilus Discord if you are interested. There's so much information, dude. I mean, there was so much information a year ago, and there's like double that now. And so as things are coming to fruition, and yes, I know people who are looking at the share price and only the share price and are, only looking at it from that lens, as he said, we're more than a share price, we're more than a ticker symbol. If you're looking at beyond that, these guys are doing amazing things. And yes, I think they're going to have more updates. But like I'm saying, like my sentiment is that, every time I think I sort of got it, I don't, because there's always one more thing. Just like, I just thought about the other day. Remember that we were talking about this at the shareholder meeting, augmented reality. I go, shit, we haven't heard about that in a while. But that's another thing that Hyperion is working on, and so, and I don't know, like there's just so much. It is overwhelming, and it's a good overwhelming because, well, we have a lot of shares of this company, and I know you're very happy where you're at. I know if things work out, I'm going to catch up. Yeah, look at these tweets. If you haven't, and if you're on Twitter, follow Ilus Marketing, Ilus International. I wish they would just sort of consolidate it and post it from the Ilus International. That would make more sense. I know Rob was discussing that too. But I don't know. How cool is this? I mean, this isn't just some small mom and pop shop. These guys are building a big ass business. And we knew this from the first shareholder meeting, from the second shareholder meeting. And I described that second shareholder meeting as sort of, I don't know, in transit, I guess. That first shareholder meeting, they laid down the outline. They laid down the map and pretty much what they were going to do. For the most part, I'd say, Jordan, that they have abided by that. They have to have versatility. They have to change when they have to, for the market, or if they lose an acquisition or get another opportunity. I mean, I think they've stayed on point, dude. You were there too, right? You believe that?
Yeah, I agree. I think that, and this isn't like a, perfect allegory or anything, but I think
cake. I'm a birthday cake.
No, but it just reminds me of, when you see people that are new to real estate and they go to buy their first rental property. And so very much like investing in a company, the price is just the price that you're paying for the house, or in this case, the stock. And then it's difficult to actually value both of them, because even though you're the tenants usually are paying the rent, and then they're paying into the equity into the house, and then there's a little bit of cash flow coming back, and then there's actually the appreciation, depreciation in the general market. But what can happen in both, as happened to many Ilus shareholders, is that we paid more for Ilus before than it currently is, and a lot of people paid more for their houses. But it doesn't actually have any bearing on what the actual value of the business or the house that you own is. It just means that's what you paid for it. So I think that's the key takeaway for me. When I keep seeing them saying this, the only thing I can think about is I just want to go get more shares, because to your point about like the second annual shareholders meeting, or even the first, they were more of a fledgling company. And so the ideas were only that. They were ideas. This is what we want to do. But now that we're a whole 2 years into it, and a year from the second, the second meeting there, about 5 months, that now that you see that they basically accomplished everything, with a few companies that didn't pan out for whatever reasons. But now that they've actually done all this, it seems to me like the only thing that's not agreeing with us is the share price. And this tale is starting to mirror some of the things that Amazon went through too, where their internal metrics were going up for years, right? But the share price wasn't reflecting it until just one day it did. So I'm overjoyed to see all the different things that they're doing, and I can't wait to dissect that video with you.
Yeah, man. Like I said, my head's still spinning, and I like to try and like really have it together, especially when I do these shows. But I'm like, man, there's just so much information. Like, it's like, what do you say after the video? I'm like, oh my gosh, what do I say after the video? Like, there's so much, and like you were saying, I'm gonna go back and I'm just gonna start writing things down and just like re-educate myself. Agent Austin just finished a video. He has both details and big picture in there. Very easy to invest with this guy. He's not building something for a short-term pump, but long-term success. We agree. I get it. But it's things are going to take time, and like he says, we're not thinking like an OTC company. He said it right out. But listen, Jordan, like you said, that's a great way to kick off the weekend, and there is a nice weekend to enjoy. It's beautiful up here in Buffalo. I was actually outside. I was just hanging in the yard, playing with the dog, having a good time, and I'm like, I gotta cover this. So I thank you guys for joining me and watching and sharing this moment of the Ilus due diligence journey. And Jord, thanks for hopping on again at brief notice. I appreciate it.
No. Like I said, happy to have been able to join, and then super happy that Nick and Ilus were able to drop the video. Like I said, I know that we were all joking about this being the hostage video. Nobody's seen or heard from Nick in a while. But I think that once you start to understand, and at this point, I feel I have a very good understanding of it, but there's newer investors that haven't had the opportunity to meet them. Once you start to understand who the team are, it becomes a lot easier to see why they're not always on these timelines. And if they say they wanted to do a video or they wanted to meet up and they just couldn't because something else that was more pressing, i.e., company business came up. And since they constantly keep succeeding and keep doing all these things, again, in spite of it, like Nick was saying, there's other OTC companies can't even get funding, and we're still powering through with Brett and the rest of it. That I'm just happy that we have such a well-versed and powerful family. You know what I mean? Because there's so many people now supporting this stock that I don't really think there's too much that can hold us back.
Yep, I'm right there with you, man. All right. Listen, that's all we got. That's all we got. I hope you guys have a great weekend. Make it happen. Make it happen. Do something fun. Go enjoy your time, and watch this video again. I'm being 100% serious. Watch this video again, just because it's good due diligence, and I know I will be watching it again. So, no bourbon of the week yet. No bourbon of the week, but that's all I got. Remember, there's more that binds us than breaks us. You guys have an awesome evening and weekend. Peace out. Yo, you there?
Well, we're still live, so